Our main aim for today is to show you how you can generate a constant stream of high probability trade ideas from risk events, and to show you how I do it day in and day out in just really 3 simple steps. So let's take a look at what these steps are. You need 3 things to trade risk events successfully. Firstly, you need to know what events to trade, right? I know that's obvious, but that's really, for many, that's the first hurdle. They look at the calendar and they're like, wow, I have no clue what to trade. What should I prepare for? What's going to move the market? So that's the first one, knowing which events to trade. Secondly, we need to know what is expected and what is priced for the events that we want to trade. That step 2 is probably the most important one, and where I think a lot of retail traders struggle. Thirdly, we need to know what outcomes will offer us the highest probability of directional volatility. That's it. If we can figure out those 3 things, we have a recipe for generating high probability trade ideas from risk events. So let's quickly jump into this. Looking at the details, let's start with the first one, which is choosing the right events to trade. Now, it's important to remember that not every single economic data point matters equally to markets. For most watching this, you will already have come across this if you've looked at any economic calendar which has an impact rating on it, showing you which is going to be important and which ones isn't. The challenge with most economic calendars, whether free or premium ones, is that the impact ratings they give for indicators are usually not accurate. The reason for this is because the market's attention changes, and the way it responds to indicators, it'll change over time. So luckily, there are a few staples that we can look at that can help us identify an impact rating that has basically held true for the better part of the last 6 years. Now, we have 3 impact ratings, or tiers, if you will. We normally talk about tier 1, tier 2, and tier 3 data. 3 tiers that we can use to group economic data. The first tier, tier 1, these are your high impact events. These are your major economic data points. That's things like employment reports, inflation reports, PMI reports, central bank policy decisions. These are things that usually cause significant price reactions and offer the best high probability and tradable volatility reactions, the ones that we are looking for, the ones that will create enough flow for us to have conviction to trade them. Now, there are a couple of nuanced or detailed points to note about these tier 1 events, but all of those nuances fall outside the scope of this webinar. For the most part, our biggest focus is on labor data, not for every country, right? Labor data for something like the Eurozone doesn't really matter, right? I'm sure you guys have seen that. If you look at the unemployment rate or labor data for the Eurozone, for Switzerland, for Japan even, it doesn't really matter. It's only for certain economies where we really see labor data have an impact. Inflation data is important for most countries. PMI reports are also important, but normally more so for the Eurozone, for the US and for the UK, not so much for the others. And those really tends to give us the best bang for our buck. Labor data, inflation data, PMIs, and then of course, central bank policy decisions. Now, one of the most influential reports when it comes to risk events is most definitely the United States NFP, the non-farm payroll. It's something that most traders would have come across, I'm sure. It's one of the most volatile data points on the monthly calendar, and it can create some very punchy reactions across major asset classes. Now, just to explain some of the nuances that I spoke about earlier, just as a quick example, again, we can't go through all of them, but as a quick example, in terms of jobs data for the US, it's important not just to focus on the headline jobs number. I see so many retail traders, they want to trade NFP by only looking at the non-farm payrolls headline number. You cannot do that. You have to include the other measures, which sometimes, depending on the economic situation that we're in, can be even more important than the non-farm payrolls number. Things like the unemployment rate, your average earnings month over month and year over year. You have to look at all of these things. And the importance of these components, for example, they will vary depending on where we are in the economic cycle. If the economy, for example, if the economy is booming, right? If we're doing super well and the unemployment rate is near cycle lows, then one higher and one lower number probably won't matter for the market, especially if that cycle has been going on for a while. But if the market thinks the economy is at a potential inflection point, very much like we are right now with the US, and the markets think there's a risk of a slowdown happening, then even a small upside surprise in the unemployment rate matters a lot more compared to when we are at cycle lows and the economy is booming. So context, super important, nuance, very important. For the most part, our focus when it comes to trading risk events, we'll be trading tier 1 events. They tend to create the most amount of volatility, and that's what we want as risk event traders at the end of the day. Then we can move on to the tier 2 data. Now, for the most part, we don't always look for banger trades on tier 2 events because they tend to not always have as much volatility. But there are times, very much like the times we're in now, where they can actually produce some amazing opportunities. I mean, again, the context with these events, tier 2 events, are critically important. Take a look at this quick example. Now, here's a trade that we took out of the PPI a couple of weeks ago. We went long euro dollar. Now, the PPI, it's a data point that we won't normally trade PPI, right? It's important, but it doesn't offer the same amount of volatility compared to CPI. But what happened to this particular event, this particular PPI, we had a massive strong beat in the data, but we knew that the beat that we had wouldn't have changed much for the bigger picture. We knew it wouldn't make the Fed budge. We knew it wouldn't do much for positioning, and also knew that even though the beat was strong, it wasn't punchy enough to see the markets ignore the soft patch in US data that we were seeing at that time. So we basically just faded the initial strength in the dollar that pushed the euro dollar lower. We bought in and we just traded it higher. A very, very simple trade, but a good example to show you that you can trade tier 2 events as well. There's another example. Now, this one was just, it's a trade we took on the S&P out of the initial jobless claims data, and we also had the retail sales data. Both retail sales and claims are tier 2 events. But at the time, the context meant that a big surprise to the upside would have offered decent volatility. We knew because that was the context we were in. The reason for this was because the markets got all jumpy and all fearful following that most recent NFP report that we had. Markets were going, I mean, ass to grass dovish on the Fed and pricing in aggressive rate cuts from the Fed. So we knew that any solid labor data like jobless claims and any solid data about the consumer like retail sales would push back on those slowdown fears, would push back on the rate cut fears, and that could be good for both equities as well as the US dollar. So when the data for both jobless claims and retail sales came in solid, we simply just jumped into a short-term dollar trade on the long side, which we closed out fairly quickly, and we just let the S&P 1 run. So very simple trades, very good recent examples to show you that even though something might be tier 2, it can still be market moving in the right context. And by the way, I'm not just sharing these trades with you out of thin air. Every single trade that we'll be going through is trades that is timestamped in Capital Edge in the Discord. So, there's full transparency there. You guys can go and check them out if you want. Let's move on to tier 3 data. Now, these are the ones we can just ignore, right? These are things like the trade balance, production data, manufacturing data, personal credit, mortgage application, housing data, inventory data. These are things that they look, on some very, very limited, rare occasions, they might provide some volatility, but for the most part, they are not usually market moving, and we don't waste time or energy on them trying to prepare for them. Now, we have more than enough opportunities here. On a monthly basis, if you look at just inflation data, jobs data, PMIs, and central bank policy decisions, you have more than enough opportunities for tier 1 events by itself. And then obviously, if you include some tier 2 events that might be market moving, you've got plenty of events to choose from. So that was step 1, super simple, knowing which events to trade. Step 2, this is the most important one of the 3. This is where we analyze what is expected and what is priced by markets for the event that we want to trade. The most critical step is this one. If you get this one wrong, then you don't really have an edge to trade risk events. So let's see what this second step involves. And what we'll do is we'll break it down between both economic data and central bank decisions. For economic data, we have 2 components we need to analyze. Firstly, we need to look at the calendar, find out the consensus, the prior, the forecast distribution, and look at rate pricing. And then secondly, we also have to look at positioning and price action information, pre-positioning, if you will. So let's start with the calendar composition, and let's quickly let's start with consensus. Now, the consensus, or the forecast, if you will, that's the first layer that we need to consider. This is your median forecast, right? Or the estimate where the data will land for that particular print. That means out of all of the market participants that was polled for any incoming economic data point, the consensus or the forecast is your midpoint or your median forecast. Now, why we pay attention to that is we want to see whether the market's consensus expects the latest release to be higher or lower than the prior release. it gives us a clue of where that median forecast is skewed. Are we skewed higher? Are we skewed lower? Or are we skewed flat? The reason why that's important is because sometimes the markets will start pricing in a particular outcome based on these forecasts. So we need to understand coming into a week whether the market is skewed higher, lower, or flat for a particular print. The next one we need to consider is the prior. We always want to watch what the prior print is and include that into our analysis. In the ideal environment, we want to have any beat or good outcome in an economic data point to be not just stronger than the consensus, but also stronger than the prior. Or we want a miss to be weaker on the consensus and weaker than the prior. But in some cases, that's just not possible. Some cases, your prior is just so out of whack that you're not going to get back to that number above or below. Now, the prior print is usually more useful apart from that. It's usually more useful when we consider it from a time series perspective. So let me quickly show you guys what I mean by that. In this specific example, we are looking at the US CPI print that we had on the 12th of June. Now, notice that on the calendar, coming into this event, the calendar, we know it was showing us a prior number. Let me just quickly show you guys for the US CPI print of 3.6%. That's the prior for the core year-over-year CPI. Now, notice that if we just consider that 3.6 number without looking at the chart, it doesn't really give us much. When we consider the time series chart, we can see that that prior print of 3.6% was important because any print that we got below that number, whether it was 3.5 or even lower, that would have been a new cycle low for core CPI year over year, right? So it's not just about printing above or below the prior, but rather what a print below or above the number will mean for the time series. Will it be a new cycle low or a new cycle high? That's important. Will it be a new all-time low or a new all-time high? That's important. Will it be a new multi-decade low or multi-decade high? You get the picture. Those things are important. You'll oftentimes hear the market say, lowest print since the global financial crisis. How many of you have heard that in financial media, right? Lowest since 2020. Highest since 2010. Those types of time series surprises, they normally matter more. So even though looking at the prior is good to see, it's good to have it print above or below that. But normally it's good enough to just look at it from a time series point of view to try and find those numbers where we think we'll get a bigger reaction from the markets. Now, then we can move on to the low and the high estimates. Also sometimes referred to as the min and the max estimates. Now, these minimum and maximum expectations are based on polls and surveys from various market participants like economists and analysts. And the number that you see here as, for example, the low, that means that is the lowest estimate from all of the analysts and economists that was polled for that particular print. And the high estimate is the highest estimate out of all of the analysts polled. Now, knowing that distribution between various forecasters means that we can see when a specific data point prints outside that range, which normally triggers bigger volatility. If we print below the low or above the high, that matters, right? So something that adds additional value is calendars that can basically give you a warning when the data point prints outside this range. So if it prints below it or it prints above it, that's very handy. Generally speaking, when a data point prints below the low or above the high, it's important because it surprises everybody that was polled for that event, which can in some cases lead to increased volatility. And again, that's exactly what we want. Now, the next one we have to consider, also in line with the low and the high estimates, is the forecast distribution. This is awesome. This is where we take a look under the hood at where all of the participants that was polled for an event have their forecast place. Now, for big events like NFP or CPI, where we have lots of estimates collected, this can be extremely helpful in knowing what type of numbers are necessary to really surprise the markets. The quick and easy way that some traders use this is to look at the minimum and the max and say, okay, cool. If it's below the low, I want to short it. If it's above the high, I want to buy it. There's nothing wrong with doing it that way, but there is a better way. If I can see that, for example, the low or the high estimate is a clear outlier and very far away from all of the other estimates, then we don't necessarily need to print below the low or above the high to get a decent reaction from the markets. The reason why most people don't use this information is because it takes a lot of time. It takes a lot of work to do. And most people just don't want to do that work. For most, they just want to have the easy way. Oh, it's below the low, it's above the high. Fine, sometimes that can be good enough. But for those of us like me who likes to go the extra mile, willing to put in the time, this can be a game changer. Now, this is what forecast distributions look like. And again, this was for the US CPI data that was released on the 12th of June, the one that we looked at on the calendar. It's the same for data points, right? CPI year over year, CPI month over month, CPI core month over month, and CPI core year over year. Same data points we looked at earlier. But these graphs now show us where the analyst that was polled for this, where they had their estimates. So remember, our goal is to find high probability numbers where we think the markets will be surprised enough to see a decent reaction from. So let's take a look at one or two of them and I'll show you what I mean. Let's start top left. In the top left, which was the forecast distribution, that's core month over month. Notice that the low estimate, the low for this was 0.1, and the high estimate was 0.3. We knew that from the calendar. But you don't have to be a rocket scientist to see that that low of 0.1, it was a clear outlier on this chart. Even a print of 0.2 was a clear outlier when you compare that to this massive cohort of analysts that was all expecting a print of 0.3. So knowing that information means that we probably don't need to see a print below the low. We don't need to wait for a print that comes in that low. If we just see anything close to 0.2 or lower, we already know that's going to be a big surprise for the markets. Can you guys see? Very, very simple to use, but very powerful if you want to look for those numbers without, just looking at the low and just looking at the max. Let's take a look at the next one. Let's take a look at top right. This gives us the year over year also for core. Now, we know that the low estimate was 3.4%. The high estimate was 3.6. But again, you don't have to be an expert analyst to see that that low of 3.4, it was a clear outlier year. There was literally only one analyst out of this entire cohort that was looking for a number that low. So that means that we probably don't need to see a print below 3.4 to expect a decent move. Look, if we got something below 3.4, it would have been a monster surprise. But even just printing at 3.4, it probably would have already been enough to surprise everybody. And that could have led to a decent reaction. So this is a really good reason why just looking at the low and the high estimates, it doesn't really give you the full story. If you are waiting for data to always print outside the low or the high, you might be missing out on some really, really good trades if you wait for that to happen. Now, the last one we need to check is rate expectations going into key events, right? What are money markets expecting from the relevant central bank ahead of the data releases? More importantly, assuming that we do get a big surprise, beat or miss, is there anything in the rate expectations that can give us a clue about how money markets might react? In this case, there definitely was. Notice that heading into that CPI release for June, money markets were pricing in 30 basis points worth of cuts for the Fed by the end of the year. And it was only a December cut that was fully priced in, 100% priced by the markets. So from this, it gave us a lot of information. From this, we knew that both an upside and a downside surprise would have been really important for the markets, because a really strong CPI print could have been enough to see markets starting to place doubt on that fully priced cut for December. And a really weak CPI print could have been enough to see markets starting to fully price a cut by November instead of just December. So either way, this told us that a big miss or a big beat would have been very meaningful for the markets. So now that we've gone through our step 2 in detail, let's take a look at step 3. Now, this is where we take all of this information that we literally just looked at, and we try and find high probability scenarios, build high probability scenarios that we could look for as possible triggers to trade. Now, by means of example, let me show you what our scenario planning inside Capital Edge was for that CPI print. Here you have the same numbers we looked at: US CPI year over year, CPI month over month, core year over year, and core month over month. What you'll notice is that we went through all 4 of those key measures. And then what we did is we built out scenarios that gives us the ideal dovish or the ideal hawkish outcome. These are the numbers we wanted to see to give us a trigger to jump into a trade. We had the forecast distribution, the highs and the lows. All of that gave us the numbers that we were looking for. So for example, let's take that core year over year number, the one we can see over here. You can see that we were looking for a number that was 3.4 or lower to give us the ideal miss. And we were looking for a number that was 3.7 or higher for the ideal beat. If we quickly come back to the forecast distribution that we looked at, let's find that core year over year. Here we go, top right. We knew that the minimum expectation was 3.4, but looking again at the forecast distribution, we also knew that that 3.4 was a clear outlier. And even at 3.4, it would have been a number that would be big enough of a surprise to surprise each and every single participant except just one. That is where we got our minimum threshold. That or lower would have been fine for a miss. Also remember, if you take a look at the time series, we looked at this as well. We knew that at 3.4, that will also give us a brand new cycle low if we got that type of print. So very, very important. In terms of what we were looking for a beat, the number that we were looking for was 3.7. How did we get there? Even though 3.6 was also an outlier, right? Just like 3.4, take notice of a very important point here. Notice that the prior that we just looked at, the time series, was sitting at 3.6. So for the ideal beat, we wanted to have a number that doesn't just print in line with the outlier, but we wanted to have a number that goes above the prior to give us that real shock factor in the inflation number. And that's how we got to our 3.7. Super, super simple. Let's take a look at another example. Let's take the core month of month. We spoke about that one as well. Our trigger for this, for a big miss, was 0.2. And the ideal trigger for a beat was 0.4. Now, again, how did we get these numbers? The exact same way that we got the European numbers that we just looked at. From the calendar, we knew that the minimum expectation was 0.1. The maximum expectation was 0.3. Now, we also knew that 0.3 was the prior number as well. So from the distribution data, we saw that the minimum of 0.1 was a clear outlier. You don't have to be a rocket scientist. You can see there's only 2 people that's looking for that number. So that means that even if we printed just at 0.2, that would have already been a big surprise. And it would have surprised every single one of this huge cohort of people that was looking for 0.3. What about a beat? Well, if everybody except 6 or 7 is looking for 0.3, we can't settle for 0.3. We need something above 0.3, which means that if we got 0.4, which was our maximum threshold for a beat, that would have been enough to surprise the sheer bulk of analysts and participants for that CPI number. Now, what we also have to include in our scenario planning is how we think broad asset classes would react on each of these types of prints. And of course, we need to choose which assets we prefer to trade on each of those outcomes. Now, for this particular data point, we were looking for Kiwi dollar longs if we got a decent miss. And alternatively, we were looking at T-bond longs as well. And for a strong beat, we were looking for potential euro dollar shorts. Now, our selection here was based on a couple of different factors, the fundamental outlook for the Kiwi at that stage, the sentiment outlook for the Kiwi at that stage, positioning was also important for those 2 pairs. But to save us some time here, I'm not going to go into all of those specifics. Just know that there was a good reason why we chose Kiwi dollar as the long and euro dollar as the potential short. Now, after choosing our assets, what do we have to do? We have to prepare our charts, right? We can't just pick an asset and then wait for the data to come out and then, okay, where do I get in? Where do I get out? You need to do that before we get into the event. You have to be prepared for it. You have to know where you need to look for profit taking on big moves if you get that big surprise that you're looking for. Now, this was the Kiwi dollar. That's our preferred asset that we were looking to trade. This was our choice to go long with if we got a big miss. And for this pair, to find key levels was really, really simple. We had that very obvious triple top key resistance sitting right at a psychological level around that 62 psychological level, 62.10. So that was an obvious area where we wanted to consider taking profit on any potential move to the upside if we got a miss. Now, there's actually a bit of a cheat code that we can use for finding good levels. It's called implied volatility levels, but we'll look at that in the next example. So that covered all of our bases of what we needed to trade that CPI event. We gathered all of our information. We built out our scenario plan, we built out our trade plan, we prepared our charts, and now it was just down to waiting for the data. We looked at the consensus, the prior, the forecast, the distribution, the rate pricing, positioning, and pre-positioning. Everything told us, right, we are prepared for this event. We can just wait for it and see whether we get a trade. Now, in terms of how it's played out, I mean, the actual outcome was an absolute whopper for that June print, guys. The actual release that we got on that print, it was almost a perfect miss. What you'll notice here about this extract from the Capital Edge calendar, I've built in a cool feature that highlights the data points where you get an ideal miss, right? So if you get that ideal outcome that we looked at in the scenario planning, it'll actually highlight red. If you get the ideal beat, it'll highlight green. So very, very handy, this one. The minimum and max thresholds that you can see here, this min and this max, that was part of our scenario planning. Like, we went through that. All of those minimum numbers we were looking for a miss, maximum numbers we were looking for a beat, that's these numbers over here. So when you get these numbers, these highlights trigger. When you get these numbers, the green highlights trigger. Very simple. So just to visualize this type of miss in terms of our scenario planning, we basically got 3 perfect misses that we were looking for in order to trade this as a miss. It was literally only one of them that didn't give us our minimum threshold, but even then it was still a solid miss because it was a print below the forecast and below the prior. So it was a new cycle low. It just wasn't the number that we were looking for to give us that like ideal outcome. So when we saw that sea of red in the actual column, we didn't hesitate for a second. We just pulled the trigger on our Kiwi dollar long, like we planned in our scenario planning on the charts. And here is how that played out. On that miss, the price was moving excessively fast, which meant that I got a pretty bad fill on this trade. That's a pretty bad fill in terms of how I normally get into the trades, but that's okay, because on a miss of that size, you have conviction that price has room to run. So even getting in at a relatively bad fill, it doesn't really matter because you still have room to make up towards your level. If I saw price spike right into that key level, then I wouldn't have, touched the button, obviously. But we were still miles away from getting to that level. So you've got more than enough time to run. So got in literally as soon as my button allowed me to. Got in close to 61.75, and we exited in line with our trade plan and our chart planning that we did just ahead of that key resistance level. That's that same 62.10 level with the triple top that we looked at in our chart preparation. So there was a very simple but good example of a high probability trade just by following all of the steps. You know what event to trade, you know what to look for to get the data. Once you have the data, you build out your scenarios, and then you just wait. You just have patience and you wait for the data. Now, what would have happened if we didn't get that ideal outcome for a miss? We would have just not traded. It's simple. A lot of people get frustrated by that because they say, oh, you spent hours going through this and building this plan and you did all of that, and then it's for nothing. Saying, yeah, it's for nothing, but out of those 10 events that we trade, I only need 2 or 3 or 4 really good ones. And then it's off to the races. You don't need a huge amount of profitable trades. I would rather trade less and have more wins than trade 100 times and lose 50% of them. For me, that's just, doesn't suit my personality. Now, let's quickly take a look at money markets. Remember, we looked at rate pricing ahead of the event. We got exactly what we expected to see as well. Recall that the market was only fully pricing in before the CPI print, was only fully pricing in a December cut at that time. Now, we knew that a solid beat could see the market starting to price out that December cut, but we also knew that a big miss could see the market starting to increase those cut expectations. And looking at the pre and the post event money market pricing here, we can see that the markets went from pricing in just an 87% probability for a November cut to fully pricing in a November cut, meaning that the markets went from expecting just 39 basis points worth of cuts to expecting 2 fully priced cuts by the end of the year. For those of you who don't know, these types of shifts in money market expectations for rates, they are very, very meaningful for markets. And it can usually create big punchy reactions if you know that a potential shift can happen. It's not always that you have the market set up this way. It's not going to be every single data point. So those data points where there could be a shift between more cuts and no cuts, they will matter more for the markets, and that can create fantastic opportunities. Now, let's quickly take a look at the second example. And for this one, again, we're going to follow the exact same process. Now, it's important for me here to mention that not every single data point that you get will be tradable like this. On some weeks, you can get very lucky and have 3 or 4, maybe even 5 big events, and all of them gives you big deviations. But there will also be weeks when you might only have 1 that gives you a good opportunity. And on very rare occasions, you might not even have 1. Doesn't happen that often, but it happens. So these examples were from data points that gave us a really high probability trade. But not every single US CPI event or not every single NFP that we'll be looking at now will give you this type of outcome. It always matters it depends on the deviation that we get. We want to be patient and wait for those really good opportunities where the deviations makes it worth us risking our capital on the trade in the first place. So with that said, let's quickly take a look at that second example. Now, again, For this one, we'll be looking at the NFP that took place in May. And because we already went through the process in the prior example with a lot of detail, I'm not going to go through all of the intricate details again. We'll just touch on them briefly. So just like the CPI example then, the first one, we need to go through consensus, prior, forecast distribution, rate pricing, and then after that, positioning and price action. Now, on the consensus side, what does this tell us? It didn't really tell us much. We could see that the market was expecting another decent NFP print from the US with 243 jobs expected, with only a 60K drop from the prior and only a very small downward revision expected from earnings. So there wasn't a lot of, pre-event fears or angst from the markets at all. Now, in terms of the prior data that we had, there are two things that stood out to us when we looked at the time series. Again, looking at it this way doesn't tell you much, but if you look at the charts, it can give you clues as to what type of numbers can really surprise the markets. Now, for the unemployment rate, for example, we saw that the prior cycle high was sitting at 3.9. The prior was 3.8, but the prior cycle high was 3.9. So we knew that any move back into prior cycle high territory or higher potentially would have been an important negative for the markets. The higher this goes, the worse it is, obviously. Furthermore, in terms of earnings, we saw that year-over-year earnings prior was sitting at 4.1. And importantly, this was also the previous cycle low. So we knew that anything below that would have already been a new cycle low. But there was something else here. Look how close we were to that 4% level. Now, usually when there are number changes in cycles, especially if you're going from a cycle high to a cycle low, or if you're going two cycle highs or two cycle lows, number changes sometimes gets the markets, it gets more notice. In other words, if we were able to go from a 4 handle, 4.1, to a 3 handle, 3.9 or lower, basically cracking below that 4% level, that psychological level, we knew that would have been a big surprise and something that markets would be noticing, taking notice of. So let's move on to the low and the high estimates here. There wasn't much that stood out in terms of the low and the high estimates. So we moved on to the forecast distribution. And again, just like the CPI data, we dived deeper into this to see, okay, do we have any outliers in the estimates? Now, as usual, the forecast distribution, it didn't disappoint. This gave us some fairly obvious numbers to look for to expect a big reaction from the markets. Let's take a look at NFP itself, top right, showed us that the minimum estimate was 150,000, 150K. But again, clear outlier. We really only needed to see a miss just below 190 to surprise literally every single analyst apart from 2 of them. So 190 was our minimum threshold. Very obvious level there. What about the year-over-year earnings one? Now, year-over-year earnings, we just looked at that from a prior point of view. At the time series data, we knew that a miss below 4.1 would have been a new cycle low. But with the distribution, we saw that the vast majority of analysts was expecting a 4% print. So again, a miss just below this would not just have given us a new cycle low, it would have given us that, but it would also be a miss below the low and a new cycle low. And we are going from a 4 handle to a 3 handle. Those are the types of shifts that the markets really take notice of. So we knew that a number like 3.9 or lower, obviously, would have been a real big deal for the markets. Then we moved on to positioning. Like, even though positioning wasn't really an important consideration for the CPI example we looked at, it was definitely a very important consideration heading into the NFP print. Notice that CFTC data at the time was showing us that the dollar was the second largest net position, long position among the major currencies. And looking at the chart, we can just see how stretched things have become from relative to the recent past, right? This is looking at the 80 percentile. That line there is looking at the 80 percentile based on a 52-week look back. So positioning was extremely long the dollar going into this. That's important to remember. The positioning was also clearly playing out into the price action. If you take a look at the dollar index, we saw a solid amount of bullish pre-positioning heading into that NFP print. You didn't have to be a rocket scientist to know that the markets were very long the US dollar, looking at both positioning and just the price action itself. Now, this was quite an important consideration for us into NFP because it showed us that the biggest surprise for the markets would have been a miss as opposed to a beat in the NFP. And a beat could have still been market moving, but with positioning that stretched on the long side, there was a much greater risk for downside risk on a miss than there would have been upside risk on a beat, because the markets were clearly already adequately bullish, if you want to put it that way, for the dollar. Now, looking at this, we knew a big miss. That would have given us the ability to see a lot of that stretch long positioning potentially unwind. And that could create some pretty solid moves, especially in the short term. Doesn't mean it changes the fundamental outlook. It just means the markets might be so long something at a particular point or so short something at a particular point that if you get something that pushes against that, it just tumbles. And that's the type of surprises that we are looking for. Now, let's quickly take a look. All of the data was collected. We looked at all of the data, the consensus, the prior, the low, the high, the forecast distribution, the pre-positioning, positioning itself. We had all of that information together. Then we built our scenario plan. Here is the example of the scenario plan that we built and shared with the Capital Edge guys ahead of the NFP release. Now, it has all 4 key points we need to watch: the NFP headline, the unemployment rate, and obviously the average hourly earnings month over month, year over year. And it also has the numbers that we looked at for the ideal miss. We looked at what type of reactions we were expecting from various major asset classes. And we obviously, in terms of asset selection, our choice for trading this, a miss, would have been either a long in the Aussie dollar or the euro dollar. And in terms of a hawkish outcome, we would have been looking for pound dollar short, Aussie dollar short, gold short. Again, I'm not going to go through why. As always, it's going to be based on the fundamental, the sentiment, and positioning reasons at that time. Now, just like the CPI example we looked at, we had to prepare our charts and see if we could spot any key levels that we could use for profit taking, right? In case we got some big surprise miss or a big surprise beat. Now, what's great about this part is that you can use any technical level that you want, whether it's a psychological level, a fib level, a pivot point, a swing point, key support and resistance levels. It really doesn't matter. For me personally, something that I've grown, very attached to, I would say that, grown very attached to as a risk event trader is implied volatility levels. I find them to be an invaluable set of tools to use for intraday trading when looking for high probability areas for support and resistance. Now, for those of you who might not know what these are, you can think of implied volatility levels as a type of pivot point. And they are essentially just dynamic levels of support and resistance that change every day. And we calculate them from using from options data. Now, by using the implied volatility for an asset, we can derive objective, not subjective, but objective price levels, which the options market deems as high probability. A 1, a 2, and a 3 standard deviation, as you can see here on the chart. And for the most part, the options market has these levels set as levels where they think price will stay contained within. Now, of course, price won't always stay contained within these levels. Sometimes on a big tier 1 event like NFP or CPI, you could see it slice straight through the first and the second, sometimes even the third level fairly quickly. But these levels act as fantastic zones to consider for profit taking and stop loss placement. So had our charts, we had our fundamental reasons for choosing the Aussie dollar and the euro dollar, and we had our 1, 2, and 3 standard deviation implied volatility levels, right? Now, if we plot these levels on the chart, it looks something like this. It's still the euro dollar on the left, still Aussie dollar on the right. And here we have the implied volatility levels plotted out for us with the 1 standard deviation low on both, the 1 standard deviation high and the 2nd standard deviation high as well, because we expected a bigger reaction if we got a miss compared to a beat. If we were expecting this to go the other way, we would have obviously prepared for lower levels. So with our scenario planning done, our charts were prepared. All we had to do, just like the other one, was wait for the data to be released and see whether we got the type of deviation that we were looking for to give us a trade trigger. So let's see how that played out. Again, super big whopper of a release, this one. All 4 job measures gave us our minimum threshold for a very big miss. Here on the right, again, is our scenario planning, the same numbers that we looked at. No secret sauce there, the minimum threshold, a maximum threshold. And we can see here that all 4 of them came in with that minimum that we were looking for a huge miss. Literally every single one of them. You don't even have to think twice. When you see that, you just trade. So all 4 job measures gave us our minimum threshold for a big miss. Very, very simple. Let's see how it played out. It was quick, was massively quick. Got filled just above the implied volatility high, which meant that my next obvious target was the next level. So if you only get filled at above the 2nd standard deviation, you're going to be looking for an extension back up to the 3rd standard deviation. So very, very simple. Entry for this, again, it was so fast because that deviation was a monstrosity. That was a really big miss. That was literally as quick as I got my fill. It could have been worse. Sometimes it is worse. But in this case, it was such a huge miss. We knew we had opportunity for the price to extend up. Now, the Capital Edge community made a killing on this trade because they were well prepared for it, right? They knew exactly what to look for. So when the release hit, there wasn't any double guessing and is it a trade? Isn't it a trade? Should I get in? Shouldn't I get in? Once I saw that numbers, it's like, boom, you're in the trade, you're running it. There's no questions about it. We acted, we executed the trade immediately without hesitation. Now, again, these types of perfect outcomes, they don't come around all the time. We don't have this every single day, but they happen more than enough to give us decent opportunities to trade. So now that we've gone through the 3 steps for economic data, let's just quickly look at central bank policy decisions as well. For central bank policy decisions, the second step, that's the most important step, involves collecting data such as the market's rate expectations, statement expectations, and obviously guidance expectations. Furthermore, and just like the economic data releases, we also need to think of things like positioning and things like price action. So for the first example, on the central bank side, we'll be looking at the FOMC policy decision that we had in March. Now, let's jump into the first part of step 2, and that's obviously rate expectations. Now, heading into the March policy decision, there were some very interesting developments taking place in interest rates as a result of a few hot CPI prints that we had. Notice that in February, markets was pricing in 113 basis points of cuts for the Fed, which was just shy of 5 cuts, right? 4.5 cuts priced by the end of the year. But then something happened. Inflation data surprised massively to the upside, both CPI and PPI, which saw markets trim back those cut expectations by quite a bit. I mean, a month later, in March, just ahead of another batch of inflation data, the markets had dropped their year-end expectations for cuts down to 94 basis points, all the way from 113, basically implying just shy of 4 cuts. So we went from 4.5 down to 4 cuts. Now, notice that between the Feb and the March CPI, markets had also flipped their May expectations, right? From a 75 basis points probability of a cut to a 72 probability of a hold. Then on March 12th and 14th, we had another batch of CPI and PPI data. Both of them came out with huge upside surprises. So that meant that by the time that we went into the FOMC policy decision, money markets were only pricing in 74 basis points of cuts, but coming all the way from 113. And the probability of a June cut had dropped to just 66% probability from 100% probability back in February. So the bottom line is that the money markets, they were very hawkishly priced going into this March decision. So let's take a look at the next thing to analyze then, and that is the statement, the projections, and obviously the guidance. Now, the March meeting was one of the Fed's quarterly meetings where we get the updated summary of economic projections, which meant that markets was waiting for a fresh batch of PCE projections, growth projections. But as always, all of the focus was on the Fed's dot plot. What do they have to say about rate expectations? Now, we can see here looking at the December summary of economic projections, that the prior one before the March meeting, that the Fed at the end of 2023, they had projected 3 possible rate cuts by the end of 2024, with a median dot sitting at 4.6. Now, because of all of the upside surprises we had in CPI and PPI, markets was expecting the FOMC to upgrade this forecast back to 5.1. Right. So in other words, if you take a look at this from a dot plot point of view, the market was expecting the median dot, which was set in December at 4.6, to be pushed up to 5.1 going into the March meeting. So the market was expecting the Fed to project just 2 cuts for 2024 instead of the 3 cuts that they were pricing in or projecting back in December. Now, these hawkish expectations, guys, from markets were firmly baked into the price action. You know, you can see a very strong bullish pre-positioning as money markets shifted those expectations following all of those upside surprises. March CPI, March PPI, and then the markets just went for it. They're like, wow, okay, now we're just going to start pricing in projection changes from the Fed. So we had all of our information. We looked at the rate expectations, what is expected from the statement, what is expected from the guidance. Then we could do our scenario planning, building out the scenario we wanted to trade. Now, this was an example of our scenario planning that we did for that FOMC. We knew that consensus was looking for the dot plot to shift from 3 cuts to 2 cuts, which gave us a very simple trigger for both a dovish and a hawkish side, right? If the dots remained unchanged, that would have been a punchy dovish shift versus market expectations and what the markets had already priced in, especially to the dollar at that time. In terms of things like PCE, markets was expecting a small upward revision. Why? Because the Fed's if they are going to increase their dot projection, it's probably going to be down to the higher PCE projections. So they expected that to be upgraded. And again, we knew that if that came in unchanged, it would have been a big surprise. For the statement and guidance, because the markets was expecting, again, the dots to be revised higher, they were also expecting subtle hawkish changes in the statement to reflect that hawkish shift in the dots. So that meant that a largely unchanged statement and a largely unchanged PCE and dot plot projection would have been a huge dovish surprise for the markets. Think about it this way. The markets were so hawkishly priced that even a Fed that made absolutely no changes to their projections would have been seen as very dovish. Not because they changed anything, but because the markets were so incredibly hawkishly priced. So with our scenario planning built, knowing what we were looking for, at this stage, we were looking for dollar downside on a dovish surprise. And that was our preferred trade. We had to wait for the decision and see if we got any dovish or hawkish triggers. And that's exactly what we did. Now, let's see what happens here. Huge dovish surprise for the markets. The Fed decided to go against market expectations, and they left their 2024 median dot unchanged at 4.6%. Big surprise versus the market's hawkish expectations that had been building up into the event. Furthermore, in terms of the statement, largely unchanged again. The Fed didn't change their language because they didn't change the dots, right? So instead, they opted to not overreact to those 2 months worth of hotter data, and they just kept mostly everything unchanged. So coming back to our scenario planning, this is what we got. We got two very dovish shifts, unchanged dots, unchanged statement with a in line with consensus PCE projection and QT announcement. So remember, the unchanged dots was the reason for the market's massive bullish pre-position. Those unchanged the expectations for changed dots was the reason for the bullish pre-positioning. The unchanged dots for this meeting was probably one of the simplest and most predictable reactions that we had in 2024 for any central bank decision. Remember that markets were very hawkish going into this. They were very bullish heading into this. The dollar was pushing higher and higher as the markets thought that the Fed will up their year-end projection. Now, let's take a look at what happened. That's the dollar before, and that's the dollar after. One of the most predictable moves for 2024 so far. No rocket science involved at all. Literally just covering all the bases to know what the markets was expecting and then building out those scenarios that we knew would surprise the markets enough for a trade trigger. A very good opportunity to capitalize on with that very clear pre-positioning. Again, markets got too bullish too soon, and they had to reprice when the Fed didn't do what they've been pricing the Fed in to do, if that makes sense. Right, so let's take a look at our next example. This one was for the RBNZ policy decision that we had in May. Now, again, we'll cover step 2, just like we did with the FOMC example, starting with rate pricing. Now, heading into that RBNZ decision, markets was leaning dovish in their view for the RBNZ, with rates expected to be kept on hold at the meeting. But there was growing expectations that the RBNZ will adjust their cash rate projections to show earlier rate cuts than previously projected, right? So heading into the May meeting, we can see that money markets was pricing in a 77% chance of a cut by the bank. Now, this was because markets was expecting the bank to bring forward their rate cut expectations in their OCR projections by a whole quarter, and in some cases a whole 2 quarters. So at their February decision, this was the one from February, the RBNZ signaled that they projected the first possible cut to only happen in the second quarter of 2025. And some participants coming into that May decision was looking for the bank to bring that forward by either a whole quarter to Q1 2025 or Q4 2024. That's why rates markets were basically pricing in a 77% chance of a cut for that October meeting that we looked at, that 77% priced. That's why they were looking at that number, because they thought, okay, the bank is going to bring that forward to Q4, and that'll be our signal that our pricing is correct. Now, looking at CFTC positioning at that time, we could see that the markets was already close to stretch short territory on the Kiwi dollar, with participants shorting the currency in anticipation of that more dovish RBNZ. Now, this was not just reflected in the positioning data, but price action on the Kiwi was ugly at that time. I mean, we clearly saw how bearish markets were on the Kiwi, just looking at that Aussie Kiwi run that we had to the upside. Strong trending move higher following that February decision out of the RBNZ. Lots of bullish positioning, lots of bullish pre-positioning going into that decision. That's important. Now, looking at the RBNZ versus other major central banks, markets were pricing in close to 2 full cuts for the bank compared to no cuts for the RBA, which was, again, the key driver for that move higher for the Aussie Kiwi pair. So again, with all of our info collected, time for step 3. Now, you should know that step 3 by now, it's building out our scenarios, right? So based on all of the info, what was expected from rates markets, what was expected from the statement, what was expected from the projections, this is our scenario planning for that event. The main focus for this was what the bank had to say about those OCR projections. Notice that what we said on the OCR projections, what we were looking for a hawkish surprise, we said that even though leaving the OCR projections unchanged was the consensus, those outside calls for cuts to be brought forward meant that even an unchanged OCR would have been seen as hawkish by the markets. And that could have created some upside for the Kiwi. Now, our preferred trade for this was very simple. It was the Aussie Kiwi short or long. If we got a dovish or hawkish outcome, it's a very good pair to trade policy differentials with. So with our scenario planning built and our preferred trade plan sorted, we literally just had to wait for the event to play out, just like the others, to see whether we got the dovish or the hawkish outcome. This is what we got. The RBNZ came out even more hawkish than our most hawkish expectation. Now recall, not only did they disappoint those dovish expectations that was looking for them to bring forward cuts, they actually went over and above that. They upgraded their 2024 OCR projection from 5.6 to 5.7, and they pushed out the rate cut expectation from Q2 to Q3. So it wasn't just hawkish, it was even more hawkish than our hawkish trigger that we were looking for. So that was very hawkish, right? Now recall that markets were very bullishly priced on the Aussie Kiwi ahead of that decision. So we knew that a hawkish surprise would have been a big surprise and would have gone against that strong bullish positioning enough to see a nice trigger lower. So with that in mind, here is how that trade played out. Just a fantastic, fantastic trade. This was our entry directly after the decision. Now, even though markets, this was a weird one because even though markets initially pushed lower on this pair, the market actually had a strange pullback directly after the event, where the pair almost pulled back about 70% of that initial move, which was weird. Now, when I saw that, we added risk to our short, saying that, okay, it's a high conviction, and once London opens, we expect the pair to start pushing lower as European traders get to their desks. And the trade, I mean, it gave us opportunities to take profit on multiple levels. We had more units because we added more risk, so we had more units to take off and basically allow the trade to run a little bit longer than we would normally do. So all in all, a very simple and a no-brainer trade if you just knew what type of trigger you needed to see to have a high probability trading opportunity. So that wraps up our simple but effective 3 steps for finding high probability trading opportunities with risk events. There really is no rocket science involved in what we do with risk events. For the most part, it's literally just putting in the time, putting in the work, and more importantly, using the right tools to help you identify where those really high probability opportunities are coming from in terms of incoming events. Now, we've been busy now, guys, for the last, 60 minutes or so. And I think we've had a really good run and shared exciting things during the session. It's hard to cover everything, obviously, that there is to know about this in just 60 minutes. But I think this gives you a really, really good framework to build from, right? It gives you a really simple 3-step process to follow. It's not going to be a one and done deal. This puts you on the right journey, but it'll take time. It'll take a lot of practice to get to a level where you are efficient. And I would say, surgical enough with your analysis and your trade execution.